Right now, in data centers across the world, something extraordinary is happening. Every time you ask an AI chatbot a question, every time a company trains a new language model, every time a cloud provider stores another petabyte of data, somewhere a tiny piece of silicon is working overtime. That silicon is flash memory, and it's become one of the most critical components of the entire AI revolution. While everyone talks about the processors, the GPUs, the chips that compute, very few are talking about the chips that remember, the ones that store all that data, the ones that feed those hungry processors trillions of bytes per second. And that's where today's story begins. In this video, we're going to analyze one such company, one that just became independent again after nearly a decade, one that just posted results that surprised Wall Street. Now, before we go any further, the usual disclaimer. This video is strictly educational. It's not financial advice. I'm not telling you to buy or sell anything. Every investment decision should be your own, based on your own research, your own risk tolerance, and your own financial situation. If you find this kind of deep dive useful, feel free to hit the like button. It helps the channel. And if you're new here and you want more content like this, subscribing takes just a second. All right, let's get into it. The company we're looking at today is SanDisk Corporation, ticker SNDK, market NASDAQ, United States. Approximate price, around $667 as of early February 2026. Market capitalization, approximately $98 billion. At this valuation, SanDisk is now firmly in large-cap territory, one of the bigger players in its space. What does SanDisk actually do? Let me explain this simply. You know how your phone stores photos, apps, and videos? That storage is flash memory, specifically a type called NAND. SanDisk is one of the world's leading manufacturers of NAND flash memory and solid-state drives, SSDs. Think of it this way. If data is the new oil, SanDisk makes the tanks that store it, not the refineries that process it, the storage tanks. And here's what's changed. AI doesn't just need processing power, it needs storage speed. Massive amounts of data need to be written, read, and accessed in fractions of a second. Traditional hard drives can't keep up, SSDs can, and SanDisk is a pure play in that exact space. Let's look at the most recent numbers. Fiscal Q2 2026. Revenue, $3.03 billion. Year-over-year growth, plus 61%. That's not a typo. Revenue grew over 60% compared to the same quarter last year. Gross margin, 51.1%. This is where it gets interesting. The previous quarter, gross margin was 29.9%. Now it's over 51%. For those unfamiliar, gross margin tells you how much money a company keeps after paying for the direct costs of making its products. Going from under 30% to over 50% in one quarter is a dramatic shift. What does this mean? It means SanDisk is not just selling more, it's selling at significantly higher profit per unit. That's a sign of strong pricing power and healthy demand. Earnings per share EPS, $6.20. This beat Wall Street's expectations by roughly 63%. When a company beats estimates by that margin, it usually signals that the business is moving faster than most analysts anticipated. One specific segment stood out: data center revenue growth, plus 76% year over year. This is the AI effect. Hyperscalers, if the Amazons, Microsofts, Googles of the world, are buying massive amounts of enterprise SSDs to power their AI infrastructure. Key events and developments. A few important things happened recently. 1. The spin-off, February 2025. SanDisk became an independent public company again after being part of Western Digital for nearly a decade. This gives the company strategic focus and allows investors to own a pure flash memory play. 2. Rebranding, January 2026. SanDisk announced that it would retire the Western Digital branding on consumer SSDs. Popular product lines like WD Blue and WD Black are being renamed SanDisk Optimus. This consolidates the brand identity under one name. 3. Partnership extension with Kioxia. SanDisk extended its strategic manufacturing partnership with Kioxia, a major Japanese memory producer, through 2034. This secures long-term production capacity, which is critical in a market where supply can be unpredictable. 4. BiCS8. SanDisk is rolling out its 8th generation 3D NAND architecture called BiCS8. In simple terms, this allows more data to be stored in the same physical space with better speed and efficiency. It's the kind of technological edge that matters in a competitive market. How the market perceives this stock. Right now, the market is paying close attention to SanDisk. After the Q2 results dropped at the end of January 2026, the stock jumped nearly 16% in a single day. It's currently trading near its all-time high. Why? Because the AI narrative is powerful, and SanDisk is positioned right at the intersection of AI infrastructure and memory demand. But here's what's worth understanding. The memory market is cyclical. It has historically gone through boom and bust phases. When demand exceeds supply, prices and profits surge. When supply catches up or demand softens, margins can collapse quickly. This isn't speculation. It's the documented history of the semiconductor memory industry. The market appears to be pricing in continued strong demand. Whether that demand persists at this pace, that's the unknown. Let me give you some context on how the stock has moved, purely for educational purposes. According to the data provided, 1-year performance, approximately plus 1,500%. Year-to-date, 2026, approximately plus 142%. To put that in perspective, purely illustratively, if someone had invested $1,000 in SNDK 1 year ago, that position would have grown to approximately $16,000 based on observed past performance. Now, let me be absolutely clear. Past performance does not guarantee future results. This example is purely educational. It shows what has happened, not what will happen. Markets can reverse. Stocks can fall. There is no certainty in investing. This is not an invitation to invest. It's context for understanding. Risks. Based on observable data. Let's talk about what could go wrong. Based on the information available. 1. Cyclicality. The memory industry is notoriously cyclical. SanDisk is currently benefiting from tight supply and strong demand. But if the market tips into oversupply, as it has multiple times in the past, prices can fall and margins can compress rapidly. 2. Concentration of demand. A significant portion of SanDisk's recent growth is coming from the data center segment. That's tied to AI spending by a relatively small number of hyperscale customers. If those customers slow their purchases, or if AI infrastructure spending moderates, it could impact results. 3. Valuation. After a 1,500% move in 1 year, the stock is priced for continued strong execution. Any disappointment, even modest MUI, could lead to sharp corrections. These are not invented risks. They are structural realities of this sector. Potential without promises. On the other side of the equation, here's what makes this situation analytically interesting. SanDisk is now a focused, independent company in a sector experiencing structural demand growth. AI isn't going away. The data being generated globally continues to grow exponentially, and all of that data needs to be stored somewhere, not fast. If SanDisk continues to execute, if demand remains strong, if its technology maintains a competitive edge, then the company could continue to benefit from these tailwinds. But could is the key word. This is not a guarantee. It's an observation based on current facts. Let me offer a quick comparison to help frame this. If you invest in a broad semiconductor ETF, you get exposure to dozens of companies across the chip industry: memory, logic, equipment, design. Your risk is spread out. Your returns tend to follow the sector average. With SanDisk, you're making a concentrated bet on one segment: flash memory. If that segment outperforms, you may do better than the ETF. If it underperforms, you may do worse. This isn't about which is better, it's about understanding the difference in risk profile. Concentrated positions can deliver outsized results in both directions. Let's bring this together. SanDisk is a newly independent company operating in a critical segment of the tech supply chain. It just posted results that significantly exceeded expectations. Its gross margins have expanded dramatically, and it's riding a wave of AI-driven demand. At the same time, the memory industry has a well-documented history of cyclicality. The stock has already moved substantially, and the valuation reflects high expectations. This is not a recommendation. This is not financial advice. Every investor needs to do their own research, consider their own situation, and make their own decisions. What I can say is this: SanDisk is a company that deserves to be understood, not just watched from a distance. This isn't a promise. It's a case study in how structural shifts in technology can create analytical opportunities. If you found this breakdown helpful, consider leaving a like. If you want more deep dives like this, subscribing helps you catch the next one. Thanks for watching. See you in the next video.